Everybody doing? Anybody have anything super exciting going on? No? All right. Well, I'm just going to go ahead and jump right in then since we're starting a little bit late. So let me share my screen and we'll get started. Maybe. All right, now we'll get started. All right, I think most of you guys looking at the names in here already know who I am, but hopefully you're here for the March update, market update, which is going to be for really mostly February numbers. Can you guys see like the complete screen or do you see my like presenter version out of curiosity?
Looks like the presenter version.
Okay. All right, let me see if I can get this. I don't know why I'm having so many technical difficulties today. Sorry, guys. All right, there we go. Now the regular one.
Yeah, it's better.
Cool. Thanks. Sounds like Oliver. All right, so just a quick, you guys, most of you again know who I am. So I've been an agent since '04. I'm an investor and also a coach. Love for you to follow on social media. We're going to get into the market trends. So as we normally do, talk about the national numbers first, definitely touch on rates, hit on some of the ways that being a local economist of choice can help you to present value. Obviously, I'm sure everybody on here, I think everybody on here is probably an agent. And what we know is that obviously with the NAR settlement and all of that fun conversation, everybody's looking at how do I increase my value? And I think values become an overused buzzword, but I'm going to use it because it's the best descriptor, I guess. But I think being a local economist of choice is one of the best ways to do that. And there's a couple reasons. One is that I think most agents are relatively ignorant to the economy, and why things happen the way that they do. And I think it can be, if it's something that's your jam, obviously you guys can tell I enjoy it. It definitely can be a nice differentiating factor between you and other agents. But I think there are a couple other things that you can do around both lending and even in new construction that can really differentiate yourself and help you sell more houses pretty much right away. So I'll get into that a little bit. And then for those of you that are here in Central Ohio, I'm also going to go through the specific Central Ohio trends. I will say right off the bat that the national trends and the local trends are definitely have the potential to be different, more so than maybe over the last 2 or 3 years or 4 years. Things have kind of all moved in the same direction. We're definitely starting to see some local markets slow more than others. Other markets kind of stay hot. So we can talk about that, and even some sub-markets within the local market. So we'll discuss all of that stuff as much as we can. All right, so we'll jump right in here to the national numbers. So looking at last month, we see the inventory was almost completely flat, which is interesting, kind of not abnormal, but just funny to see a straight line there. But we were up 14.8% year over year. Again, these are national trends. So I know we had some markets in the US that saw a huge increase, others that were kind of flat or maybe even less than last year, but that was the national trend. In terms of pending listings, we were really right on the same track as 2023. So the pink line here is 2023. So pending listings are kind of in line. You can see maybe a little bit more than some of the years past, but in line with where they've been over the last few years. And then new listings, which is really, in my opinion, the driver for what we're looking for. Obviously, we want it to be better than last year because last year was absolutely terrible. But as we start to approach some of these other years before that, we can see that even though we're better than last year, we're still quite a ways off of what was considered normal when we go back to pre-pandemic numbers. So I think we're about what is that? About 100,000 or maybe a little bit over 100,000 fewer new listings nationally in February, which is obviously pretty significant. So, and I think you see that throughout most local markets as well. Days on market's kind of right in the middle. Um, so again, we're obviously above the 21 and 22 numbers, but we're actually a little bit better than last year. Again, this is nationally speaking, but really kind of right in what would be either normal or a little bit better than normal. So no major signs of like a crazy housing recession by any means, um, from the perspective of like prices and demand. We do have a recession when it comes to the number of sales, but that for the most part only affects those of you on this call and everybody else that makes money based on a number of units. Median list price is slightly higher than last year, but as you can see, not by much. This is definitely a national trend that also does change when you look at some local markets. You can see last year we were pretty well above the beginning of 2022, but then that kind of leveled out as we got into the springtime and summer, and we actually did not quite get to that all-time high in terms of median pricing. Now, this is list price. So this is a little bit of a foreshadowing of what prices are going to do in terms of sold prices over the next couple months, but still usually a pretty good indication when you look at all the listings nationally. Agents, for the most part, know what they're doing in terms of pricing. And so this is usually a pretty good indication. And what we've kind of been seeing from all of the different data points that I look at is that the pricing is probably going to be nationally a little bit above last year, but probably not significant. However, when we look at the end of year, which is usually kind of where people decide whether it's up or down, a lot of that is probably going to depend on the rate environment for the last quarter of the year. Just because we saw for the last 2 years, obviously rates rose significantly in the fourth quarter, and that caused demand to drop, which also caused prices to soften, maybe even a little bit more than normal. If we look at, you guys know if you've been on this before, I love this, and even though it's very not specific to any market, what I like about it is just looking at kind of how things were pre-pandemic versus how things are now. And you can see that despite, changes in regional markets, year over year, when we look just, back 5 to 7 years, we can see just how much growth from a price perspective. So when we look at, the listing prices are up, anywhere from 35 to 50%. And then we also look at the number of active listings are anywhere from, down 25% all the way up to down 55%. You can kind of see that even though we've had our challenges with the current market, no one can say that the real estate market isn't in a really, really good position right now. And considering the fact that we've had historical lows in terms of sales, the fact that the majority that really tells us that the majority of homeowners have a significant amount of equity. And so they do have some room for prices to fall backwards, which I don't anticipate happening on a large scale, at least as of the data now. But they could really afford to see prices fall backwards some and still be okay. This was not the case back in 2008, which was one of the things that led to a lot of those foreclosures. So most sellers, most homeowners are sitting in a really good spot from an equity perspective. All right, interest rates. So they definitely are the news, and obviously the trends up or down has an impact on the emotional well-being of our buyers and sellers and probably us. But at the end of the day, one of the things that I really have liked to see over the last couple months, and it's really been since like mid-December when rates dropped off, um, is that they've kind of stayed within this range. When we look back here, obviously they were trending upwards, and then we had a little bit of stability last year during the same time period, but we all of these like drastic up and down movements, and then obviously with the trend being up, people just slowly dropped off. And I think honestly, we've had some drastic up and down movements, but if you can see here, the overall trend of rates, it's kind of stayed between 6.625 and 7.125, kind of in that general half a percent range. And for most borrowers, that change in payment is not super significant. So even though rates are higher than everybody wants them to be, I think some consistency in rates has allowed some sellers and also some buyers to start to, plan accordingly, that they can kind of depend on rates. I think largely we'll likely see, we'll know more tomorrow as we'll get into in a second, but I anticipate that rates will probably remain in this range before starting to head down whenever the general rate environment starts to decrease, which will be largely driven by what the Fed tells us tomorrow in terms of if that's going to happen soon still, or whether that's going to get pushed even further out into the year. New housing starts, I think if you're in a tight inventory market, this is something that we need to continue to see. One of the biggest challenges in um, throughout the last really decade or really 15 years has been that builders really quit building after the Great Recession, and they never really started building again at the same rate. I think in 2021, we might have touched the trend line, meaning what the average has been over time. But then we quickly dipped below that when rates started going up. And so we need to see builder confidence stay high, because even in our local markets, like in Columbus, for example, we still have a really strong inventory issue. And yet, the builders tend to be national. And although they try to make local decisions, a lot of them still do kind of trend towards what's happening in the broader market. And so when rates start going up, even though Columbus still has a lot of buyers, the builders get nervous and they hit pause. And so to see their confidence kind of back up above what they are calling, what the National Association of Home Builders is calling the break-even point, is a good thing. And it's the first time it's been above that since last July. So I'm not sure why that slide got stuck in there, so I apologize. But ultimately, this slide I did not update, so I apologize. But basically what we're looking at here is just the difference in the mortgage payments. Again, from 6.5 to 7.5, obviously if it's only moving 0.5%, you're seeing this cut in half. And so the average loan amount is probably changing anywhere from $100 to maybe $150. But not a super significant difference for the average borrower going even a full percent, compared to the change that happened when we went from 3.25 to 6.5. So I think as we see sellers and buyers continue to get used to these higher rates, I think we're going to see a little bit less reaction when we see these small changes, and we've already started to see that. So yeah, I spoke earlier when we first started about being the local economist of choice. And I think, again, just like anything, it's great if you come and listen to me or listen to a podcast or whatever. But if we don't really internalize what the numbers mean and have the ability to tell our clients what all this means to them, it probably isn't a great use of anybody's time. So my encouragement to you guys would be to pick one or two or three at the most things that you can become a a really good expert on out of this information or anything that you find, and then be ready to just regurgitate that. Ultimately, clients want to know that you know what you're doing, and when you can take this information that I've already put together for you and just intelligently replay it to them, it makes it sound like A, you're plugged in, and B, that you know what you're talking about. You don't have to be able to give this whole presentation in order to give people that feeling. So, a few things that have happened. Overall, what we're looking for in order to see lower rates is still inflation. I mean, there's two things, inflation and employment, that the Fed is charged with keeping in line. The biggest thing that stood in the way of rates going down has been inflation just being very stubborn. It has come down a good amount, and it's very close to where the Fed wants it to be. However, we've just struggled to continue going down to get to ultimately where they want to be, which is around 2%. We're like still in that like low threes. And they're just, the trend is kind of like either even or maybe even a little upward over the last couple of months. Um, but some of the things, basically consumer spending needs to slow down, and it really hasn't. So one of the things that could continue to um, help things slow down on the spending side is that if people have to start repaying their loans. Now, there are some loans being forgiven. I also believe that there's a rule that the loan companies are not allowed to report late payments for late student loan payments until after like till January of 2025. And so that could also play into it. I haven't seen any numbers on how many people are late now that the payments have restarted. But that could also be impacting the fact that people haven't slowed down. One thing that we definitely are seeing, though, is credit card debt is increasing. And we are right around pre-pandemic levels now, but where we were just a year or two ago was at record lows. And so what that tells me is if we stay on that trajectory, the party has to end at some point. So if people are just spending money on credit cards that are at 30% interest, um, it's gonna end, and the longer it goes on, the more likely it is to end very ugly. So this is something that we're definitely keeping an eye on. I think that report comes out again maybe next month, or maybe even this month. A lot of stuff is quarterly, so we'll see. I'll try to keep an eye out and have that for next time. Employment or unemployment. Employment came in high again last month, but the in terms of added jobs, but the January number, which was crazy high, it was like 3 times what they expected it to be. That was revised like in half, essentially, or almost in half, um, this month. When we got numbers for February. So still definitely hotter than what people expected, given where where the economy kind of sat 3 to 6 months ago. But it still seems like for the most part, there's not massive layoffs. People are keeping their jobs. The one thing that we're seeing that economists are keeping an eye on is the number of people quitting their jobs has drastically reduced. And this is the first economic cycle I've paid this close of attention to these types of things. But they say that that's usually the first sign that employment is getting a little bit shaky. And the reason for that, obviously, you're less likely to quit your job if you aren't confident that you can get a new one. And so they say usually when quits start to decrease, that's usually an indication that hiring is probably about to slow or is in the process of slowing. So, um, I've been kind of referencing this for the whole presentation. Tomorrow is a fairly big meeting. So basically what happens is the Federal Reserve meets, I think 8 times a year. So it's almost every month. Um, and they meet the next time tomorrow. What's important about tomorrow's meeting is the fact that every every 3 months, they do an update as to where they think interest rates are going to be over the next couple of years. So each person, each member of the Federal Reserve kind of does what they call it a dot plot, but basically they just mark like where they think rates are going to be in 3 months, 6 months, 9 months, 12 months, and then all the way up to 24 months. And so this is the first time that they've like put their guesses out there. And these are the people that are making that decision since December. And so in December, I think they were mostly predicting that the first rate cut was going to happen in June. The market thought that it would happen faster because they expected the economy to be slower. That didn't happen. I highly doubt that we're going to see a rate cut tomorrow. However, I think more than 50% of people in the market are still thinking it's going to happen in June. So if the Fed comes out tomorrow and says, you know what, because of inflation, we think that we're going to keep rates this high through the end of the year, that's going to cause mortgage rates for sure to go up. If they come out and say, no, we're gonna stick with our original plan, then I think we'll probably see rates stay flat or maybe even drop a little bit after tomorrow. So we'll see what happens. Talked about employment, and then we've talked a lot about inflation too. I mean, it's not crazy high anymore. It's definitely come down, but still has some room to go before it gets to where the Fed wants it to be. The slide does not need updated. I did update this one. Sorry, I forgot to delete that though. Recession is still split. I think probably more are in the camp of no recession, but some very, very smart people who have made some really great predictions in the past are predicting a recession. So that kind of remains to be seen. I think the longer rates stay high, the more likely we are to see a recession at the end of this cycle. But we'll see. Um, so yeah, we'll know more tomorrow. As always, I've been talking about this for months. If there is a recession, rates will go lower faster. If there is no recession, then the Fed will probably be much slower in dropping rates. And then obviously geopolitical type influences along with the presidential election this year will definitely have an impact on how all of that stuff gets through the system. All right, so how do we add value? I've talked about this the last couple of months, but I think really understanding builders. I mean, the reality is we saw that inventory active listings are still nationally 50+% lower than what we would consider to be normal. And outside of a couple unique markets, we're all in a lower than normal inventory environment. And so understanding the builders and the builder incentives and how you can get people into a property that need a lower payment that can't really get one in the resale market or need to sell their house first before they can buy, all those types of things. Go meet with all of the major builders in town and make sure that you understand what they offer and where their communities are. It's more important than ever to have relationships with them and get your clients registered, because if they go in without you, it's definitely difficult to get paid. And then same idea with lenders. And I've been preaching this for months, but I think one of the things that helped me the most during the 2008 downturn was really understanding lending at a high level. With lower number of sales, you can't afford to meet with somebody and have them decide to wait because they didn't understand financing or they thought they couldn't get financed. You just really need to be a partner with your lender and understand what they're offering, what they're doing, and be able to, in some ways, sell your preferred lender to them to make sure that the buyer has a good experience. And then obviously, that it goes without saying that in a very competitive situation, you need to have a great lender in order to even get considered by a listing agent. If your buyer is just going out and working with Joe Schmo lender, and I'm a listing agent and I have two offers that are fairly similar in price that are all over list price, I'm telling you right now, I'm recommending to my seller that we go with the known lender that's done a great job for me in the past versus the new mortgage rep from Huntington, that hasn't, that hasn't ever sold any or has only been in the business for 3 months. So make sure that you know how to explain that value to your buyers so that you don't lose out on opportunities to make a sale in a market where there are just frankly fewer sales happening. All right, this is just kind of my thought. Not a ton has changed. What I decided to do, I took a page from the Fed actually. I kind of say the same thing every month because not enough happens um, month to month. But basically, many areas are seeing rising inventory, which we talked about. Buyer activity is definitely tied to rates. So if we see rates spike significantly, I would expect a big slowdown. If you see rates drop significantly, I would expect a huge increase in the number of buyers and not necessarily listings. Remember, listings take a lot longer to enter the market than a buyer does. Our target interest rate to really invigorate buyer demand, I think the builders have proven, if you watch the builders, they stick their rates around that like 5 to 5.5%, maybe up to 6%. That is where the buyers feel comfortable getting rid of their 3.5 and moving to. When they get above 6, you have a certain percentage that peel off. And then obviously when you get above 7, when you get all the way up to 8, a large percentage peel off and you just see things kind of screech to a halt like we have the last 2 falls. This is again my favorite kind of conversation with anybody who's thinking about buying. I know match day for medical residents was last Friday. And so a lot of, most of them are going to be moving to Columbus for the next 3 or 4 years, potentially 5, but most of them 3 to 4 years. And so if you're working with any of them or run into any of them, guaranteed they're going to ask you, do you think it's worth buying a home in Columbus or should I just rent? Um, and this should be, I mean, this is, I think, a legitimate response. Basically, the shorter the time horizon, the more risk, right? Um, so it's just really not likely, though, that we're going to see a big pullback in prices. And I think a couple reasons. Number one, we've seen inflation in everything. I don't think that real estate's the only thing that's going to deflate in pricing. Um, and number two, that I just don't believe that over a 3 to 7 year time horizon, or even 3 or 4 years, that we're going to see a downturn in pricing that lasts for that length of time. So that 3 to 4 years is definitely a gray area for me. I think I'm always asking, are you comfortable with renting it if the market were to soften and you couldn't sell it for what you wanted to? But just remember that once somebody has to sell, they also have closing costs and all of that stuff that they have to pay. And so the amount of they can't just break even by prices staying the same. They have to see appreciation. And so I'm just really talking about short-term risk versus long-term risk. And I think over the long haul, the next 3 to 5 years, and especially when you get over 5 years in Columbus, you have very, very little risk that prices are going to go down. And you have a lot of risk that your rent is going to keep going up and that you've missed out on appreciation that you could have seen if you would have been owning a property. So, but it's definitely a tough conversation right now because in reality, and we'll get into numbers here when we get into the local market, but on average in the US, the average rents are lower than the average mortgage payments. And I think in most neighborhoods in Columbus right now, your average rent is going to be less than a mortgage payment, obviously depending on how much you're putting down. And so this is the first time in my 20-year career that that's been the case. So it's definitely a little bit more of a dilemma the shorter your time frame is. All right, anybody that isn't from Columbus that has any questions that wants to ask them, that doesn't want to sit here and learn about Columbus? No, you guys are just going to make me keep talking, huh? All right. So local market. I like this graph just because well, first of all, I think a lot of us like pictures, but I'm mostly looking at the gap between the actives and the solds, right? If that's shrinking, that's obviously an improving market. If it's growing, it's a market that has, more supply than the demand in it. And if we look at last year, we saw coming out of the fall time when rates had gone up, that began to shrink. It was actually in a little bit better shape last February because rates were actually a little bit lower. And then in March, it flipped to, less than 1 month of inventory. You can see here, though, the gap is shrinking as we moved into February, and I think we'll continue to see that happen in March as we go into these numbers. So you can see that the number of properties for sale is actually higher year over year on the resale side. Um, but what is interesting is that we were up on the new listing side in February this year compared to last year. So we added 16% more new listings, and this is in the Columbus market. New construction, this is a little bit less of a perfect science in my opinion, because not every new construction property gets listed on the MLS. But we do have more technically on the market today than we did last year. But you can also see that we in February we only had a little bit more, so we were only up about 5.6%. So it's these numbers are a little bit less valuable in my opinion. When we look at resale only, what I'm looking at is my February to March number, and I know Ash, Gail, you track this every week. But what we're seeing is the number of properties for sale in the middle of March was actually down 3.4% compared to the middle of February. So what that tells us is that in spite of there being 16% more new listings coming on in February, the market has basically absorbed all of those and then also actually absorbed some of the remaining inventory that had been sitting on the market. So that's a pretty significant thing. We're seeing the number of new listings in the first couple weeks of March being pretty flat. And then the year over year, though, we're still plus 10%, which is a good number. We need to see actually a lot more than that. But that's a good start. I think this number kind of shows that increase compared to last year has slowed down a little bit here in March. And I think that's probably due to those interest rates ticking up a little bit over the last couple weeks, with some sellers maybe holding off or not pushing as hard as they might have otherwise if demand was higher. But we're also seeing a significant number of multiple offers and a lot of properties, going into contract right away. Average days on market is up a little bit year over year, 3. I wouldn't consider that to be really statistically significant. The one thing I do see is that our average original list price to sales price has been kind of steady in this 97%-ish range, excluding last month for the last 5 months. And so it'll be interesting to see if we get back on average to 100 plus again this year, or if we see a little bit more of a flattening of that, which is really, frankly, a little bit more closer to normal. The amount of inventory, though, would lead me to believe that probably that number will start to go up. So we're definitely in a seller's market on the resale side, actually on both new construction and resale. We have just a little bit over 1 month of inventory, but it's starting its normal downward spring trend. You typically are going to see your lowest inventory based on closed sales happen in the month of March or April, right when all of the buyers have come out into the market, but before the majority of the sellers have. And so that's kind of that perfect spot that we're looking at now. This is new construction. We still have under 3 months, as you can see, again, because not every property gets listed on the market in new construction. It's a little less valuable in my opinion, but just kind of shows you months of inventory stayed pretty steady. So not a lot to talk about here. Average sales price continued to, slowly tick up. If you look at the rise from January to February, it was 0.6%, which if you annualize that, meaning you multiply it by 12, if we saw 0.6% every single month, we would be, I think that number would be right around what, 6.5, 7%, that we would see in in increase in sales price, which I think it's probably going to be something closer to 5, but I think if we do see rates drop, we could see that increase. So we're continuing to see a good trend. The one thing that I'm keeping an eye on here, though, is this increase from January to February was significantly smaller. Now, obviously, the decrease from December to January was smaller as well. So it'll be interesting to see if that's just this was more of an anomaly here last January, or if this is a new trend where the upward motion is not quite as much as it was last spring. So you can see how everything runs up. And what's important about that is that we almost always see a downward trend from about that July or August timeframe all the way through the end of the year. And so if we don't rise as much as we normally do, then there's a chance we finish the year with less year-over-year appreciation. All right, this is the numbers that Allison puts together for me every month. And basically, I think this just shows a pretty good indication of overall demand in the market. I think the number of showings that are happening definitely gives us a good feel for how many buyers are in the market. Obviously, the exact number isn't as important because one buyer can look at multiple properties, but I think the overall trend is something to look at. And you can see that for the most part, even in spite of rising rates from a trend perspective, that the number of showings has continued to increase, which I would say is a pretty normal sign given the time of year. Now, obviously, we only have this through last week, and so rates did bump up actually last week. And so we haven't seen a huge correlation though from with the small changes in rates with showings. So yeah, so we'll see. We'll continue to track this and see if there's any changes. Rental market. I found this on Zillow actually. I just typed in rental market in Columbus. So here's the source on this one. But I thought it was actually a really cool graph, the best one I've ever been able to find on rents. So it looks like month over month changes was plus $26. This is for all bedrooms and all property types. And then your year over year increase is $56 compared to last year. So thought that was pretty interesting numbers. It looks like we're up over last year, but maybe down a little bit from the peak that happened in the fall. So I think that's everything. All right, that's all I got for you guys. Anybody have questions, comments, concerns? Nothing, huh? Either all you guys are sleeping or...
Troy, as you said, I track it weekly. When I looked this morning, from Tuesday to Tuesday each week from the 1st of January, this week is the first week that we've actually got more homes on the market than the previous week. We have been, as your graph showed, it is a decrease the whole way through to now. So whether what we call spring selling season has started, and that's once again what your graph sort of shows. When you look forward to, yours only went to February 24. When you look at March 24, there is an increase. So I think with obviously the turn of weather and everything's case scenario, the trends that have happened in the past are probably happening again.
Yeah, and I do think there's definitely some nuances week to week with just what's happening, like you said. I mean, when it snows a little bit, maybe people, you know, go inside a little bit more than they would have, and maybe a couple weeks ago there were more people out because it was warmer, right? So I definitely think there's some of those nuances that happen week to week, which are kind of blips in the radar, for lack of a better term, that don't really, show a trend. But it's interesting because this is the first week, right, that you've seen it go up, the amount of overall inventory. So yeah, that is interesting. I mean, it's what you would expect, especially as we move into April, and May. I would be curious for those of you that have, um, listings coming up. Are you guys seeing a pretty even distribution from now until May? I know for me, I definitely have a larger sample coming on in April and maybe early May than I have had this month. So I'm just curious if that's just me or if everybody's kind of seeing that.
I'm definitely seeing the same thing. We have not much coming on this month, maybe the very end of the month, and then we have a fair amount. We have a lot coming on in April, so I'm expecting April to be a pretty big change.
Yeah, so that's interesting. So I mean, I would say I've been telling everybody, if you have the ability to get it on the market this month, it might not be a bad idea, because if we see a flood of new listings, you could see a little bit of a pause, um, in the chaos if buyers all of a sudden have a ton of choices. The thing is, though, I mean, this would be another great question, Diane and Ryan and anybody else. Out of those listings coming on, how many of them are just listings and how many of them are buy and sell?
Mine are just listings,
Okay.
unfortunately.
I had to consult the powers that be. I think ours are probably about half. We have a lot of delayed possession stuff. Stacy's here. You can't see her because she blurred out because I've got some kind of effect going on here.
Yeah.
But anyway,
Delayed possession and moving out of state, and so they have to stay here till almost June, so then that's pushing a late listing.
yeah,
Okay.
so that's some people come on late.
Yeah.
Mine are all delayed buy and sells. They haven't wanted to go to the market. They haven't been able. The inventory hasn't been there suitable for them to buy. Yeah, obviously I've said, look, there'll be an uptake in late March, April with inventory coming in. But this is the great time to get everything, get everything in a line.
Yeah, so basically what you're saying is a lot of your people are going to gobble up that inventory that comes in April and May, but then they're going to turn around and list their house in May or June. Which, I mean, again, this is a normal trend, right? But just because inventory is so tight, it's just interesting to talk through some of these scenarios. Diane, are yours mostly new construction, or are they all existing but just moving out of town or something? Or
Existing, moving out of town.
Okay, interesting.
I think we're going to see a lot. If rates come down at all, I think we're going to see the demand really pick up on the buy side too. And I don't know if you've been watching the Treasury spread at all.
I have not been tracking that, but is it tightening?
I haven't seen it. I just was looking at the slide from from Family Reunion. It was at 2.85 at the end of Q4 2023, which was the highest it had ever been on that graph, which went back to like 1990. So it looks like on that graph, whenever there's a peak, we had peaks in 2000, we had peaks in 2008, 2020, and then now. But every time we had that peak, it pretty much dramatically dropped within about a quarter to 6 months. And we're at the biggest it's been. So I don't know if maybe the risk is still being factored in there, but at some point when we start to see some negative information on jobs and on inflation, or not inflation, but on we see the positive information on inflation, negative information on jobs, if that all starts to drop.
Yeah, I think to that point, and that's something I really haven't talked about, but it is something that I'm relatively familiar with, and what it seems like if I'm reading, and I would be curious on your thoughts on this and make sure I'm thinking about it the same way you are, but it seems like as soon as the rates with the current spreads get to around 6%, somewhere in that range, that spread could crash and cause it to quickly go down to 5.5.
I think so. I mean, the margin right now is 1.74 is the average, right? It's up at 2.85. So you've got a 1.1% spread above the mean. But every time it crashed down below the line. So if you think 1 to 1.5%, maybe 1.25%, it could shrink up the rates. I don't know how quickly, but pretty fast, it looks like, because I think that's a reaction to the economy switching, which based on the credit things you mentioned, that probably will happen.
Yeah, and that's sorry if that's like way getting in the weeds, because if you're never looked at treasury spreads, this is probably, but basically it's the extra money that the servicer who you pay your mortgage payment is collecting more than normal. And basically over 1% of the interest rate right now is going to the servicers, that's not normally charged to you as the borrower. So as soon as, and what I've been told the reason for that is that almost they assume that the average person is going to refinance once rates go down. And so they're trying to make more money on the front end so that they can kind of be protected, because basically the average loan is supposed to be kept for 10 years, and they are predicting it's not going to be kept for 10 years. So the return to the investor is lower. I think Ryan just shared the slide from Family Reunion, I'm assuming, in the chat.
Yeah.
Yeah. So again, sorry for getting in the weeds. Take a look at that. Google it. But anybody else have any comments or questions, anything you guys are seeing in the market? No? I just love to hear what everybody else is seeing. And um, have you guys seen any decrease in like new client calls, or are you guys staying pretty steady?
I mean, I feel like with the trend, it's been more listing-based activity than buyer-based activity. I feel like my buyer-based activity is pretty flatline, if down, but whatever reason, there's so many lists, and these are just different reasons why people still come to list with you. So I don't think everybody has to feel like, for traditional reasons, people are listing. But I don't know. I just feel like I'm optimistic based on listing inventory.
Yeah. Cody, how about you?
I'm probably, I would say the opposite. I'm very buyer heavy right now. And I think just based on what we've been talking about, everything's hitting in April. April, May seem to be like really big months coming up. So obviously trying to be optimistic on listing inventory. But I mean, not a lot of brand new business, but people are starting to get out to open houses from what I can tell over the past 2 weekends that I've been sitting in them. So, I mean, if you can get your hands on anything, even if it's been listed for a while, I mean, people are starting to look at those conversations, and with rates stabilizing and kind of being where they're at, whether they go fluctuate up or down, I think people are, wanting to see some consistency there. So hopefully, leads to a bigger second, third quarter for everybody.
Yeah, and I mean the reality is we've been, in this crazy COVID market here, and really this is like what it's been like for my whole career before 2020 was, things got busy in the spring, right? And so it seems like we're definitely moving back towards a little bit more normalcy. And I think if we see rates stay pretty steady, or even go down, that we'll continue to just see the normal demand cycle happen, at least until the middle to end of third quarter in an election year, we're probably going to see a little bit of a drop compared to normal, just because people tend to get uncomfortable. But then I think Dana said it in her talk last week, but typically the year after a presidential election tends to be a very strong economic year. So whatever we lose in the second half of this year will likely be picked back up with a stronger beginning of 2025, which is crazy to say out loud, 2025. But yeah, anybody else have anything? Cool. Well, I'll let you guys go. I guess the only other thing, Ryan, I just thought of it, I would say I have an investor client from New York City, who's in the diamond industry, and he just emailed me yesterday and told me that his business is down 50% year over year. So back to that consumer like behavior. I don't know anything about his business in terms of like the details around whether there's more to that story or not, but I do think it'll be interesting to see. And those types of like luxury items, I feel like are a really tip of the iceberg leading indicator on that stuff. Or maybe nobody's getting married. I don't know. That could be the other thing, but anyways.
The only other thing I might add is my brother is in the trucking industry. Like he builds trailers and suspensions for heavy trucking. And he did tell me a few weeks ago that things have been really dead and they're picking back up. So they actually are seeing more orders come in, which is not a very common, or he thinks it's a very leading indicator of the economy. So they may have gone through their recession already. We may be still in our recession, and the rest of the economy is still maybe getting ready to go into, or in an earlier stage even.
Yeah, it's crazy. I had listened to something a couple months ago, and then I'll really let you guys go. But this person came on, an economist, and they said that this recession is not going to be like a recession that affects everybody at once, that different industries will go through kind of their own recession at different times for different reasons. So I don't know. I've quit like listening to predictions on that stuff because I feel like nobody knows what the heck they're talking about, but just throw
Media
it
is
out.
all about headlines, right? They want to get the headlines. They got to say something sensational, which is why we like not to open another can of worms. We'll talk about it later. But the whole change in the commission process with the settlement, that may be, another kind of thing like that will affect it. So, but anyway, that's next week.
Yeah, that's definitely another conversation. That's a Thursday conversation, I think. So, all right, sounds good. Well, thank you guys all for coming. I really appreciate it. Hopefully it was valuable. If you want to email me at troy@marshhomegroup.com if you want the slides, I'm happy to send those over to you, and we'll go from there. So you guys have a great week, and I'll see most of you probably at the office meeting on Thursday.
Thanks, Troy.
Yeah.
Thanks, mate.